Hello, friends. My name is Deepak, and with me is Sanjiv Gupta, CPA. And today we are going to talk about California taxes. I know those of you guys who live in California, you love California because it is one of the highest tax charging states. No, I'm just kidding. I know you love it for the weather, you love it for friendly people out there. Taxes is probably the least of things that you like about California. But anyhow, California tax returns are super complicated. A lot of us get a lot of information on the web, on the internet, on YouTube about what's happening on the federal government side, but not nobody talks about California, and there's a reason for it because a it's very complicated. Number two, oftentimes people just ignore these things and they just kind of move on and file their taxes. So today I want to talk to Sanjeev and understand some of the nuances, some of the problems that he see on tax return California filers. For example, Big Beautiful Bill now has SALT limitations. Do you really qualify for SALT limitation in California? What about your HSA accounts and so forth? So we're going to pick on Sanjeev's brain today to give us a little bit more information about some of the deductions that you probably take it for granted today, but you'll be surprised to know California don't. And if you skip that, you're going to get in a lot of trouble with California. So Sanjeev ji, correct me if I'm wrong. Does California make it crazy hard for you to file California tax return or not?
Well, definitely. For California return is become bigger than federal return. Let me put this way. And when we do the federal return, we always look at the numbers from federal side and think the California is going to conform to the same numbers. Our thinking is totally wrong. Why is so becoming so important? Because with when Tax Cuts and Jobs Act was enacted in 2017, California did not conform to most of the provisions of Tax Cuts and Jobs Act. When President Trump became the president second time, he brought in the new regulation, one big beautiful bill. California did not conform to that as well. Then in the COVID era, we have some laws which were enacted. We have CARES Act, we have American Rescue Plan Act, right? And then we have Secure Act 2.0, which was in addition to Secure Act 1.0, with so many changes. And then we also, one more thing was the Inflation Reduction Act. With so many changes, California did not conform to most of them. With those non-conformity, now you can see how the big that differences are. So let's take an example. Simple example. Mortgage interest. A mortgage interest deduction for federal purposes is allowed. You can deduct interest fully up to $750,000 loan. But in California, it's sticking to the pre-Tax Cuts and Jobs Act, which is about $1 million. Home equity line of credit interest is not deductible or is clumped, is clubbed together, is grouped together under 750K for federal purposes. For California, they still allow $100,000 of home equity line of credit. The interest on that loan, you can deduct it. Second difference is a major one. Health saving accounts. We always think when you contribute to health saving accounts, you get three benefits. One, the contribution becomes deductible for tax purposes. The earnings grows tax free. You can invest the money in the way you want, right? And when you take the money out for medical purposes, it's tax free. But when it comes to California, people are shocked, surprised, and shocked because the contribution that you contribute is not deductible for California tax purposes. Earnings becomes taxable. So if you make any earnings in those accounts, it becomes taxable. And withdrawal from the HSA for medical purposes, which is tax free for federal, it's not tax free for California. Qualified opportunity zones is another one. In qualified opportunity zone, if you invest money in qualified opportunity firm funds, it can defer the taxes for federal purposes. The gains will be deferred. You don't pay taxes. Now, with one big beautiful bill, they certain rate more. If you put it in those funds for 5 years, you get 15% break. 15% of tax, capital gains taxes does not have to pay because it increases the basis. And then if you put it for 10 years, it's 100%, of course. But for California, it does not follow. So even though you think you defer the taxes on the gain by putting that money in qualified opportunity funds, of course, you have to follow the rules within 180 days and all those things. But people will be surprised and shocked to pay the California taxes. And remember, California taxes has only one tax rate. There is no long-term capital gains rate. There is no qualified dividend tax rate. So it's only one tax rate, which is ordinary tax rate, which is starts from nothing zero till 13.3%. So that's another difference is there. And then we are going to bring major difference. Others major differences are depreciation. People have rental properties. People have rental property in California. They have rental property in California. In rental properties, the depreciation plays a very important role. Now, you can claim 179 depreciation from federal side if you're a active participation managing it actively, and you can claim 179. Bonus depreciation on equipment, on furniture, fixture inside that. Of course, that's limited is allowed, but California does not allow that at all. The basis can also be different when you do all those things, or when you sell the rental property, the recapture might be different for California tax purposes, which may impact you a lot because the depreciation recapture in case of federal might be different based on whether you took the more depreciation recapture or you did cost segregation. That's another difference. Passive loss limitations are there for federal. California generally follows passive loss regulations, but because California takes the income from federal AGI and then it add back all the federal benefits to arrive at a California taxable income, then they calculate the California tax rates. So it can give, so in case of rental property, passive losses, you can deduct up to $25,000 allowance, but California does not allow that $25,000. State tax refund, for federal tax purposes, if you itemize, you can deduct, if you itemize, you can take of course, the state tax refund. If you itemize, you have to pay taxes, otherwise, no. 1 year, California does not tax the refund. Moving expenses, California provides moving expenses, which is disallowed under Tax Cuts and Jobs Act in 2017. Disallows that one. Gambling losses is deductible up to winning losses. Again, this follows the pre-Tax Cuts and Jobs Act. All the losses from gambling, they're allowed to the extent of winnings. With one big beautiful bill, they limited it to 90% of the winnings. The losses, so you still will be, the winnings will still be taxable up to 10%, which is not allowed. Health insurance for S corporation shareholders. In case of, if you're a California corporation, California treatment depends on payroll reporting and wage, how you include the wages for tax purposes. This this has a lot of errors when it comes to reporting that medical insurance on whether you report it on the W-2 or whether you report on the Schedule A itemized deductions or adjustment to income on 1040. It differs from California return. Like kind exchanges. Now, in case of like kind exchanges, California allows you to sell California property and invest in other state properties. But when you ultimately sell that property, let's say the property is located in different states, you keep doing 1031 exchanges from one state to another state. When you ultimately sell it, you will going to pay the California taxes because it's a deferment. So, so that's a lot of time people forget about 1031 exchanges. So California do tax. Because if it's a California property and you do 1031, yes, California allows it to do 1031 in other states. But when you sell that other state, when you sell that property, ultimately the California wants your shares. The IRA basis tracking 8606, as you put money into Roth IRA or non, the CA tracking becomes the tracking for CA tax purposes becomes a mess if you don't do it properly. What is 8606? Like you put money into non-deductible IRA because of AGI limitation, or do you backdoor Roth? If you don't calculate the basis, the CA basis will be totally rough. Then we talk about the tax credits. It's huge. Credits are California has its own credits. It's a California renters credit, California dependent credit, which is different from others. Credit still available. EV vehicle credits are still available for California purposes. Of course, you have to. There are certain rules to be followed. There are EIC regulations to be followed. In capital gains, as we know, the capital gains for federal purposes, we have a separate capital gains rate: 0%, 15%, 20%. California does not have that capital gains rate, so we know that that is going to be there. Net operating losses for federal tax purposes, if you have net NOL, right? If your annual can go up to certain limits. Annual can be, you can claim annual up to 80% of business income, right? The rest is carry forward. There's no such thing as California has its own limitation. Sometimes certain years they give full deduction, certain years they limit it. It's based on the California laws and regulations to 12, again, QSBS, qualified small business stock, the two stock. Federal allows you I will say pre one big beautiful bill. The federal law allows you to claim up to $10 million of gain arising from sale of 12 or two qualified small business stock. Now, in one big beautiful bill, they've increased it to 15 million. And they also provided if you hold it for 3 years, 4 years, and 5 years rule, which is not there in Tax Cuts and Jobs Act, but is there in one big beautiful bill. California does not confirm it. So even though you pay no tax from federal side, the gain is less than $15 million. If you sell the QSBS after July 2026, you will be surprised that you still owe California taxes on that QSBS stock because California does not allow the QSBS deduction. So these are some of the major differences. You can see how big difference it can happen, and then that can create a lot of challenges when you do the California return for tax purposes. There will be a lot of difference in that area.
So, Sanjeevji, any recommendation for California residents that you would say, because a lot of people try to do tax returns on their own or online using some of these softwares. I mean, a lot of these people walk in and you're surprised to see that these returns are often wrong.
See, the thing is, generally we take the differences, generally we don't even look the differences. And I will say franchise expert in a way, they're not very, they think they are very expert, but they're not looking at those returns objectively. I will say that. So a lot of times those deductions, those misreporting errors are missed out. Okay. Because like I said, California return is very big. It takes from federal AGI. And the differences which I just told, there are huge differences if you start looking at those things. What they care most about the differences is whether you are in California resident or non-California resident. Whether you're, you're paying now in California we have pass through entity elective tax, PTET tax, where you can work around the SWOT limitations, whether you're doing it right. So they are more concentrated on that area, EDD issues, the wages issues, but like a mismatching of HSA plans or QBI deduction. QBI deduction is another difference that is there. QBI is allowed for federal purpose, but not there for California tax purposes. QSBS differences, qualified opportunity fund differences. All those differences are very difficult to match unless you have the federal return and your system to see whether what these differences are coming and reconciling properly or not.
So there you go, guys. If you are a California resident, or maybe you have something going on in California, maybe you own a property or business and you need to file California return, then keep these things in mind because you'll be very shocked how often these returns are wrong because people miss out on some of these minor nuances. Sanjeevji, thank you for bringing this to everybody's attention. I think people will really appreciate it.
Thank you, Jit.